Let's talk about silent killer in construction businesses. Overhead. Overhead ain't evil. You need office staff, insurance, accounting software, phones, trucks, and a place to sit when it's raining. But if you don't measure it, and I mean really measure it, it'll eat your profits like a fat kid left alone at a donut wall. That's where the overhead ratio comes in. Here's what it is. Overhead ratio equals the total overhead divided by total revenue. Simple, right? You take all the expenses that don't swing a hammer. Your admin payroll, your rent, software, insurance, office supplies, subscriptions, coffee pods, and the cell phone you pretend is for business use only, and then divide that by your total revenue. So let's say your overhead for the year is $300,000 and you do $1.2 million in revenue. So that's $300,000 divided by $1.2 million equals 0.25% or 25%. That means 25 cents of every dollar you bring in goes just to keeping the lights on. Now let me ask you something. If your gross margin is 30% and your overhead eats 25%, what's left? 5 cents. 5. You worked an entire year to keep 5% of your revenue. Congratulations, you just ran a multi-million-dollar company on margins smaller than a gas station hot dog. So what's a good overhead ratio? It depends on your size and setup. Small contractor doing under $1 million, you might run 20 to 30% overhead, sometimes higher if you wear all the hats. For a mid-sized firm, you should aim to get under 20%. For high efficiency operators, I've seen them at 10 to 15%, but they're lean, mean, and ruthless about cost control. The trick isn't to eliminate overhead. The trick is to make sure your margin can support it. Don't bring in $1 million and act like you can run a $5 million office. That's how you end up with a shiny new plotter printer and an empty bank account. Let me give you a real world example. I had a client, we'll call him Mike, who came in doing around $2.5 million a year. He had a project manager, an office manager, a rented office suite with a view, every software tool under the sun, and guess what? His overhead was chewing up 35% of his revenue. That's almost $900,000 just to run the shop. With a gross margin of 30%, that math didn't work. He was profitable on paper, but his actual bank balance said otherwise. We trimmed the fat. We cut down the software to what they actually used. We streamlined payroll, moved the office to a smaller space with no skyline view. We started tracking overhead ratio monthly like it was his blood pressure. Within a year, he was back to 22% overhead, and real profit showed up for the first time in 3 years. Now, you don't have to be a penny-pinching monk to run lean. You just need to know your number. That's what overhead ratio does. It gives you a target. And if you're not tracking it, you're just guessing. Guessing in construction is how you go broke real quiet-like. So here's your homework. Pull your overhead expenses from last year. That's everything that doesn't directly build the job. Then divide it by your total revenue. That's your overhead ratio. And then 3, ask yourself, can my gross margin support that? If not, you either need to raise your prices or cut your bloat, or both. Remember, overhead isn't just about costs, it's about control. If you let your back office grow like weeds in a job site ditch, you'll choke out the profit that's trying to survive. So keep it lean, keep it measured, and never forget, you don't get paid for having an office. You get paid for finishing jobs and keeping what's left.